Well, hey, welcome back. Happy New Year. We're joined again by Casey Hazen, Senior Portfolio Strategist at Horizon. It's good to see you, man.
Yeah, good to see you. Happy New Year.
Same. Your beard's looking excellent as usual.
It's a little bit longer because it's quite cold up here in Charlotte. So once we get back into warmer weathers, maybe I'll shorten it up a little
Well, maybe I should have grown mine back out. It's cold here in
bit.
Georgia today. So today is actually kind of exciting because we've got some good news about the economy, but this I think is an important how do I say this ethically? This is an important update for you guys to consider because there may be some things that could brew, some potential highlights that we have in our presentation today that I believe would be something you should be considering as well and be watchful. Just keep eyes on. At least know that we're watching it for you. But we'll get to that point when everything gets started here. So yeah, Casey, I know we've got a couple of things brewing as it relates to COVID and some things that Trump has done. So would love to hear what you've got for us as it relates to the Trump boom that we're seeing.
Yeah, that's a great place to start here. Because to your point, yes, like we have had a handful of really strong years. Not only for, the stock market, but for, US GDP growth. Once again in 2025, we saw really strong economic growth, despite there was lots of uncertainty and hiccups along the way, but we did see a really strong year for the economy. And one of the main reasons why we've continued to see really strong GDP growth is because we are in the midst of a very large economic injection. And I think this is something, like it says there at the top, it is quite unappreciated. But the scale of all of this AI, CapEx, and some of the other stimulus that came along with some of the tax bill that was passed last year amounted to somewhere around 5% of our GDP growth that we saw last year. And again, 5% of the US GDP is a very large number.
Huge.
In 2025, the GDP for the US came in right around $30 trillion dollars. So if you think what's 5% of that, that's right around $1.5 trillion dollars. So a significant amount of economic injections are going in right now to similar scales that we saw in the past, like the railroad. Obviously, it's not necessarily as large as what we saw back in the COVID-19 pandemic with a lot of those checks that were going out to individuals, but still
Yep.
something to be very aware of and a reason why we've seen the economy continuing to improve here.
Yeah, I'm tracking with you on that. On the COVID piece, I remember the stat came out that we had generated more financial stimulus and printed more money in 6 weeks at the beginning of COVID when all that was happening during the entire 18 months of the great financial crisis to just show
Yeah.
how much money we pumped into it. It's insane.
Yes.
Okay.
Um, and so, along the way, corporations have obviously been very strong as well. They've benefited from a lot of these improving economic backdrops that we've had. And one thing that we note here is that, corporate America right now is very healthy from like a balance sheet perspective. This looks
Mhm.
here at their debt service ratio. So basically, what's their debt levels relative to their income or their earnings. And you can see we're at pretty much historic lows, somewhere similar to where we were in the kind of early teens era, which was, again, a very healthy market environment. A lot of corporate America really started to deleverage their balance sheets following, the 08, 09 great financial crisis. And that trend has really continued over the last couple of years. So despite all the concerns around, AI spending and CapEx spending and, stories about, these companies borrowing tons and tons of money, we're really still very healthy from the amount of debt that is on corporate America's balance sheet right now.
No, that's good. I appreciate you sharing that one. One of the things that stood out to me was if you just kind of take things in without context, really, you'll hear about the indebtedness of the nation or personal debt, and you'll be led to believe that it's and it is a problem in places, but it's a problem everywhere. But I'll never forget around 2010, I think it was a phrase coined, the great deleveraging. And it was because of the great financial crisis and everything was over leveraged. Everyone was getting blown up because they borrowed too aggressively. And so what my understanding was is that by 2020, you had most of your significant corporations having longer term debt at those historic lows that have never been and may never get seen again. I don't know if we'll ever see 2 or 3% like we did. Um, Whereas today we're accustomed to 6 or 7%. But
Yep.
at the same time, I feel like if this chart really does speak well, that we're at that same place as we were right after the great financial crisis settled out. So that's hopeful, at
Yeah,
least.
very much
And who
so.
wants to borrow money right now, right? So anyway,
Um, I mentioned AI, and we're definitely going to continue talking about it because it is a very large driver of the economy right now. It's a large driver of corporate earnings growth. And the question that everybody wants to know is like, okay, we've seen ChatGPT now for the last 2 or 3 years, starting to understand how to use it. So we think that this is going to continue going. This is going to continue being built out. Like, where are we at? What inning are we in? I think is the question that we get a lot. And so just comparing this capital build out to similar build outs that we've had in the past with other, call it like innovative technologies. You can look at like telecommunications back in the 90s. You can look at things like the oil and gas build out in the 70s or 80s. Railroads, if you want to go all the way back to the 1800s, these capital build outs follow a somewhat similar pattern. And so right now, based on a lot of estimates that are out there, this comes from Vanguard, but it looks like we're still fairly early stage with the infrastructure build out that's currently going on right now. And so as it relates to how this is impacting economic growth, that's basically what the x-axis there is showing on the left-hand side. It is obviously positively contributing right now to economic growth, but there's still more room to the upside for AI in this build out to contribute more towards economic growth as infrastructure continues to get built out and as some of the productivity benefits that are expected to be seen continue to contribute to further growth. So, still think we're somewhere in the early stages, maybe the third inning, or at the very latest, maybe the start of the fourth.
well, that's hopeful. I think people who are mindful and this, it feels like we've been in the semblance of uncertainty for, I don't know, post COVID. It's just, or we found last time during our review that some of the people who were feeling the highest level of anxiety were just people who didn't vote for Donald Trump, right? When we bifurcated based on partisanship, we found that most of your negative sentiment was just because their person didn't win. And so that's not to negate the emotions of people who didn't get what they were voting for, but it's rather to speak to, the clickbait and the sentiment around most of your posts or your citizenship was more relegated to something that was not actually economic. So this is really exciting to believe that we have more growth, and I feel like corporations are going to continue to flock to AI. You hear it everywhere. You're either using ChatGPT as a person to better write emails, or people building out websites and building entire corporate infrastructure with it. So it's exciting to see what'll come from it.
Yeah, very much. And yeah, to your point, we can't talk about AI without also talking about yeah, profitability. Oops.
Yes.
And this is really the benefit that we're expecting to see from AI going forward, and we're already starting to see some of the benefits here. And this is kind of a simplistic way to look at profitability or productivity rather, is the amount of hours worked and the amount of output that those hours are able to produce. And you can see we're comparing kind of this ChatGPT era and post ChatGPT era to the internet build out in the early to late 90s. And you can see here since ChatGPT, we've seen a pretty substantial uptick in the amount of output relative to hours worked. Very
Hmm.
similar to what we saw back in the 90s, where you introduce this new technology, internet, personal computing, and all of a sudden, workers were able to produce more with a
Yeah.
similar amount of hours worked, or at some points, less hours worked. So we expect this trend to continue going forward.
No, that's good to note. I remember us discussing the adoption rates of personal computers versus the adoption rates of using internet or cell phones and all these emergent technologies for us as a people group. And the adoption rate of AI has been significant. And that left chart really does show you how quickly we have been bringing in AI, and that response should continue. I would assume as people continue to integrate it.
Yes. So obviously, we are very optimistic at Horizon about AI continuing to drive a really strong economy. As Chris pointed out at the beginning of this call, there are things to maybe be watching. And one thing we can't not talk about is the rising unemployment rate. We have seen unemployment tick up over the last several quarters. You can see it there in the kind of bottom left-hand corner. And historically, all of the red lines there are going to be periods where the US was in a recession. Um, there's a very high correlation between rising unemployment and a recession. Generally speaking, you don't kind of escape a recession while you see unemployment rise, more than a percentage point like it has here in the US over the last couple of years. But clearly, we are not in a recession, and we have not been in a recession over the last couple of years. Um, so it's something obviously that does give us a little bit of a pause and a little bit of a concern. I will say that it has been a very strange last handful of years with this unemployment that has been increasing. It's just increasing at a very, very slow rate, which is atypical from what we normally see when unemployment rises and we go into some sort of recession. Generally, it starts slow and then all of a sudden it just rapidly picks up. We have not seen that this go around. You can see it's been now about 30 months, so 2.5+ years of rising unemployment, but we're really only about a full percentage point, a little bit more, from the lows that we were, back a couple of years ago. Um, One reason that, we believe is why we have not seen unemployment tick up more substantially, or we haven't gone into some sort of recession, is because, again, corporate America earnings growth has just been very, very strong
Yeah.
over the last handful of years. And if you think about it, if you're a company and you're making more money than you've ever made before, it's probably not a time to shake things up. It's probably not a time
Yeah.
to, announce mass layoffs because
Yeah.
it's just not necessary. So for us, obviously, we are always watching what's going on with earnings reports, and earnings have been very, very strong over the last handful of years. If we start to see some sort of downtick in earnings growth or some surprises to the downside, to us, that could put more downward pressure on the labor market and lead to a more substantial uptick in unemployment, but we're just not there yet.
Yeah. I'm connecting with you on when things are doing great, you don't tend to rock the boat, right? So I wouldn't expect layoffs unless there's some other exogenous thing that occurs.
Yeah, exactly. Um, and again, like you can't escape connecting AI and the labor market, right? Like we hear all the time, AI is gonna destroy the labor market, of course, right? Um, and as Lee Corso says, not so fast, my friend. Um, what we have seen so far, and again, this is not to say that this trend will continue forever and always, but what we have seen so far is over the last couple of years, really since ChatGPT has been around, some of these other AI technologies, is that occupations that have higher AI exposure are actually growing at a much faster pace than occupations that do not have exposure there. And what's maybe more important or more impactful is that these companies with this high AI exposure are seeing much, much more significant wage growth than everything else. So we would not say that, AI is going to not impact the labor market. It's not going to take away jobs. That's not what we would say whatsoever. There for sure will be a shakeup in the labor market. Jobs that exist today will not exist 5, 10 years in the future. But if you think about any sort of new technology or innovative technology, that is always the case. Jobs
Yeah.
that can be replaced by technology will be replaced. But what it will do, in our view, and what it has always done in the past, is create new jobs. So while there will
Yes.
be jobs that are available today that are not available in 10 years, there's also jobs that aren't available today that will be available in 5 or 10 years. And so for us, that's what we're more excited about. There will be some disruption, but again, this has happened before, and we don't really see any reason why this would not continue going forward.
Yeah, I appreciate you sharing that one piece. I think we have in our minds sometimes like a Hollywood dramatic fear-based AI is going to take over. I'm not sure that I can fully engage with Elon Musk, who says that we're basically going to all have some type of autonomous, no need for cash, and live a life full of robots and AI, and we're going to be in some utopian type future. But
Yeah.
you can see that, right? So 100 years ago, when we were maybe more agrarian and industrial revolution was coming on, um, those jobs were replaced by better jobs, and certain things aged out, and an old way of doing things was replaced with a new way of doing things, and new jobs were created. So it's the concept that maybe we don't need to be so fatalist, and it doesn't mean that something negative couldn't occur. We could be in a Terminator Skynet coming becoming self-aware, but that's also a movie that was made. So maybe it's a forecast for us, but I don't think it's as it's not a near and present fear as it maybe could be in our minds.
Very much. Yes. Well said.
Thanks.
Um, so labor market is absolutely something that we're watching. Right now it's on
Yes.
okay footing. But again, corporate earnings are still very, very strong, so it's stable at this point. Another concern that we have here, and our CIO points out th this quarter, is there is a potential for an attack on Fed independence. Um, Right. And like this has happened many, many times in the past where governments have gone in and tried to influence monetary policy making. And every single time governments try to intervene with monetary policy, it works out not great. Every single time it leads to a depreciating currency, and it leads to higher bond yields. And you think about right now, right? We know that Trump is very, very interested and pushing very hard for lower
Yep.
interest rates. He would really like to see Jay Powell cut interest rates down to zero, to help make borrowing costs cheaper for, things like housing and just, financing daily life. Um, but again, if Trump does want lower interest rates, the last thing he should be doing, again, because history would tell us, is getting in the way. And here we sit. It is January 15th. It was just a couple of days ago where we saw a microcosm of this play
Yep.
out, where we saw Powell was kind of slapped with an indictment or a subpoena, basically, and he came out and said, um, that this is a direct response to the Fed not lowering interest rate. It's an attack on their independence. And the next day, what did we see? We saw the dollar sell off, and we saw interest rates
Yep.
move higher in bond yields.
Yep.
So we do think that that policy is going to be kind of walked back. We don't think that there's going to be a further investigation that's going to lead to more downside pressure with that specific instance. But it is absolutely worth noting that this could be a potential hazard going into 2026.
Yeah, I don't understand why he would try and force things lower. I'm not an economist. I'm not as smart as you are, Casey. What I would say though is the level of riskiness of our nation has effectively only gotten larger over time because of our expansion of debt and things like that. So we can artificially lower rates if we wanted to, but it feels like the people who would actually loan us money, whether it's institutionally or at a sovereign level, like our actual treasury debt. I mean, we've had some failed treasury auctions, right? So if people aren't
Mhm.
willing to loan us money, it's going to demand that we have to raise interest rates anyway. So it's kind of above my pay grade, but we can. It would actually. I have a feeling that it would actually cost us money if we had to get into some type of money printing or quantitative easing to actually effectively bring these interest rates down. It would cost the American people in the long run more potentially, and so it seems like it could be hazardous waters for sure.
Very much. Absolutely. Um, you
Let's,
know,
yep.
so beyond, beyond that, one thing to also note is that it is a midterm election year, and historically speaking, within the presidential cycle, midterm election years tend to be a little shaky. It tend to be more volatile, which makes sense because, there is this election towards the end of the year. Markets at the end of the day really don't like uncertainty. And
Hmm.
what is an election other than this really, really large uncertainty event? So, not saying with any sort of absoluteness that we are going to have, a tough year for markets. But it is worth noting that it does tend to be a little bit more volatile, especially in the second half of the year. So it's one of those things where we can be optimistic about our outlook for markets in 2026, but also noting that there might be some volatility along the way.
Yeah, I want to note, just to be sure I'm tracking on the box for year two, where you have that green leg down in the bar for Biden's second year. I want to remind you that that would have been 2022 when the Fed
Yes.
chose to raise interest rates so much, and it caused the markets and bond markets, stock markets and bond markets alike, to both crash effectively. So let's be clear, that I would maybe consider that more of an aberration unless we saw some kind of crazy Fed initiative or some other policy shift that would be that drastic. I want to caution you that, I mean, it's possible that 2022, sorry, 2020, what year are we in? 2026 could bring something like that, but there was also some extenuating circumstances that I need to be sure you guys have the context for.
Yep, exactly. Um, Again, kind of getting back to some more optimistic components here. Earnings growth, very, very strong over the last handful of quarters. Not only earnings growth, but corporate revenue growth as well. And again, looking into 2026, expectations are for more of the same. Average analyst expectations for S&P 500 growth are somewhere in the low to mid teens. So very, very healthy backdrop for equity markets heading into this year. Um, and this is really on top of many years, like I mentioned, of really strong earnings growth. And, we talk about technology, we talk about the Mag 7, and we've talked about the outperformance that space has really had over the last couple of years. But again, one of the main drivers for that outperformance is that's where we've seen the most earnings growth. The yellow line here is going to look at the technology space. And then the black line is going to be more of that S&P 500 equal weight. So not giving as much weighting towards, the Mag 7s of the world, because we know that the Mag 7s have driven a lot of the earnings growth and a lot of the price appreciation for the S&P 500. But again, it makes sense why technology has outperformed when you see it in the context of how much growth that they've had in their bottom line.
Yeah. Would you give me just 1 second on that slide to break that down and say that a little bit simpler? I'm tracking with you, but for whatever reason, most people don't understand that the S&P 500 is a cap-weighted index. So that
Mm.
means that it's based on the size of the company. So think capitalization, capital, money. So what it is that your bigger companies affect the performance of the S&P 500 than maybe some of the smaller companies. And so when you have, yeah, there was a time where ExxonMobil was the biggest company. Then it was Apple, and you have, these other tech companies now that are a large component. They would affect as much as 20 or so percent of the performance. That's one company's stock. So if it's crushing it, making 70%, that's going to bring the S&P 500 up because it is cap weighted. This chart here says that if all 500 companies were equally weighted and didn't drag or impact more than another the performance of the rest of the index, this is what it would look like. And so it's to show that S&P 500 over the last whatever year or two has remained largely flat, but the tech component has been what's driving so much of it. It's also
Mhm.
the thing that's made diversification over the last couple of years look foolish at the time. But what happens is that diversification looks foolish until it makes the most sense, and you kind of need it before you need it. You know what I'm saying? So I want to just break down and just say bigger companies had a bigger impact on the S&P 500. This chart just says if everyone was on an equal playing field, the market has not grown as much as a result, but the tech is obviously your high flying and your biggest impact. So thank you for giving me a chance to say that.
Yep. Um, and then kind of like furthering, that conversation, um, you know, one thing that we're looking forward to in 2026 is for the market to broaden out. And we're looking forward to it not just being tech that has really, really strong earnings. We're looking for cyclicals to have strong earnings. We're looking for small caps to have strong earnings. And really, over the last couple of months, that's what we've seen. This chart here kind of highlights how small cap earnings, that's EPS earnings per share, small cap earnings per share, have really started to increase off of this base that they've been kind of trapped in for a number of years at this point. One reason why small caps have struggled over the last couple of years and why their earnings haven't increased is because we've been in a higher interest rate environment. And we know that small cap companies tend to have more debt as a
Yep.
percentage of their balance sheet. So when interest rates are high and you have a lot of debt, that's cumbersome to your bottom line. Now, over the last couple of years, we have seen interest rates come down. In 2024, we had right around 75 basis points of cuts. And that's really the main reason why we're starting to see earnings grow in the small cap space is because of the rate cuts that we had in 2024. Um, when the Fed cuts interest rates, it does take a little bit of time for those rate cuts to kind of work their way through into the company's bottom line. It works with a little bit of a lag.
Yeah.
So right around a year after those rate cuts, we're finally starting to see a little bit of pickup. And then what's encouraging going into 2026 is that we had another, 75 basis points of rate cuts in 2025 that have not been realized by, these small cap companies. And so we think that's an additional tailwind going forward to continue to boost earnings growth for small cap companies. Um, It'll obviously also help large cap companies. But again, large cap companies have less debt on their balance sheets. So we think that small caps and more cyclical components that, have not been favored over the last handful of years, if all of a sudden those start to pick up a little bit of steam, diversification, which includes, small caps and some of these more cyclical value-oriented companies, all of a sudden it starts to make much more sense than this concentrated market that we've been in. So that's another reason why we're quite optimistic for 2026, especially with these portfolios that we've constructed that are more diversified. We have tech exposure, we have mega cap growth exposure, but we also have these other components within the portfolio to help balance things out a little bit, help reduce some of the concentration risk that come with owning just tech or just the Magnificent Seven names.
Mhm. Makes sense. Great.
So. Yeah, I would say that's all the slides that we have prepared. Again, we're quite optimistic with the backdrop that we have from the economy and the setup that it looks like is starting to play out with another strong year for equity markets. Um, Obviously, recognizing that there's some risks that we're keeping a close eye on, but we do think that it'll be another generally positive year in 2026.
Yeah, I'm tracking with you on that. I think it's also the things that we pointed to. Maybe those things end up being, um, the things that upset the apple cart as it relates to economic for their economic development, or maybe what the markets end up doing for this year. But it's also important to remember that Donald Trump has a way of negotiating where he'll say a great deal of things because the market not liking uncertainty, it'll react very negatively. About a year ago is where we need to start thinking of very recent history where Trump was talking about tariffs and whatnot. Markets panicked. That was 2025, right? And so, and then just what we saw was a resilient recovery. And so, what it ended up being would have been a time to add more capital to the portfolio in this, whatever it would have been, spring or early summer months, if my recollection serves, based on what the markets actually did do, or a time to potentially increase risk in the midst of the uncertainty. And so, that's why the navigation of what we do is having to stay the course, even when it doesn't make sense, and to do the exact opposite psychologically when your uncertainty is typically the highest. What was it, Warren Buffett, who said, um, when everyone's greedy, you should be nervous, and when you see blood in the streets, you should get aggressive. There's some expressions he's had which really do speak to exactly how the mindset should go. So it could be that Trump really keeps his foot on the concept of pushing the Fed and whatnot. And it could be that the markets freak out because the Fed is really what we depend on in some ways. I mean, it's in God we trust, but also it's the Federal Reserve, let's be honest, uh, as it relates to the markets, maybe, at least domestically. But it could be that he ends up 60 to 90 days walking that back, but it set a standard. It allowed him to do what he needed to do in some other arena. And it would have been that very moment where you should have increased the risk or maybe made a decision or at least stayed the course. So while we see that there could be some potential headwinds or idiosyncrasies in the future, it doesn't mean that it plays out as negatively as our psyche might lead us to. So Casey, I really appreciate your time today, man. It means so much. I know we went a little bit longer, but there was a lot to discuss, and I hope it was as good for the people consuming as it was for us to be able to produce it.
Absolutely. Yeah. Thank you for having me.
Same.